Good morning, everybody. First of all, apologies that I can't be there in person, but like stock markets, health is very hard to predict, and that's the reason why I'm not with you. I find it fascinating that this conference is about whether we're in a new paradigm, and very happy to talk to you about it because I really don't believe we're in a new economic paradigm. And the reasons why I say that is that I think that what's happened since 2008 is that central bankers around the world have intervened in the economic cycle. And therefore, all they've done is injected an enormous amount of money into the environment and prolonged the economic cycle, which is probably why we're getting sub-economic growth at the moment, compared to other economic cycles where recoveries took place much quicker. One of the things we're starting to see is a problem associated with quantitative easing, which has been one of the main thrusts of central banks around the world. And the consequences have been that buying up all these bonds in the bond market has created a position where we're not seeing a price discovery in the capital markets. Now that is a very serious situation when you can't get price discovery, and I don't know if everybody in the audience realizes what price discovery is, but price discovery is making sure there are willing buyers and willing sellers. Now when you get central banks in the world who are using quantitative easing and are buying bonds in order to keep interest rates down to very low levels, there's no real price discovery because they're putting up their hands that they'll take any amount of bonds that are on offer. Now, how does this affect us all? Well, if we can't get a risk-free rate that is reflective of price discovery, it means that the risk-free rate at the moment is artificial. And if it's artificial, we can't depend on it as our compass for future investment. And that's the big problem as far as I'm seeing. So we're in uncharted waters at the moment. We're seeing a lot of lending at the moment, which is even taking place where some borrowers in Denmark are actually paying borrowers to lend and paying them interest rates. We're seeing an enormous amount of negative interest rates on deposits, something like around the world 5.4 trillion. And these are areas that have never been touched in economic history. I'm confused, and I think many other people are confused as to where this is all going to go. And what it has done is it's creating enormous dislocations in the marketplace. So we're seeing people reaching for yields as a consequence of all this. And this is particularly hard on savers because of the fact that they are getting very little money on their deposits. Now, when you start to reach for yield, you start having to go up the risk curve. And obviously, if people are in a situation where they are very dependent on income, one of their primary aims is to satisfy that priority of getting more income. And even if they are going to take more risk, they're doing it on the basis that this is one of the things they've got to live with in order to live with. So that's one of the areas. So in this environment where we have an artificial risk-free rate, how should we make investment decisions in this environment? Well, my suggestion is to all of you is that you should forget about the 10-year risk-free rate in Australia, which is the Commonwealth Bank rate, which is probably in the region of about 2.5%, as I think it is a rate that is set around the world rather by the capital markets that take place in Europe as well as America in particular, and rather use a mean that has been established over a long period of time, let's say 30 years, where the risk-free rate, I would suggest, is rather in the order of 4.5 or 5%. So if you are fund managers and you're buying property at the moment, and you can buy excellent property at the sort of total return of 8% unlevered, and you're taking a risk-free rate of 4.5 to 5%, you're still getting a margin of 300 to 350 basis points over the mean, which means that property, provided it's quality property with long-term leases, is still something that is attractive at this point in time. So I think that's vital in making those decisions, and I think that should be vital for every other asset class that anybody's looking at. I think the biggest problem we're having with the risk-free rate in such a low level is that we're seeing a lot of behavior taking place where people are using the benchmark of the lower risk-free rate in order to buy investments, and therefore they're overpaying for some of these investments at this point in time. And when there's a normalization of rates eventually, which will take place in all the Western economies, then we're certainly going to see some adjustments to prices. And if people are highly geared, we're certainly going to see a lot of pain that will have to be taken, particularly as interest rates will rise and the discount rates will change, and therefore capital values will drop. Now, as far as I'm concerned, in times like this, where we're in uncharted waters and where things are becoming very pricey in many areas, it is vital that we don't drop our investment principles and get sucked into bad propositions. I'll give you an example of what I'm talking about. Recently, we were looking at a vendor who was trying to do a sale and leaseback to us on an industrial property, and we were agreed to buy it at a certain price with a 10-year leaseback. We were advised by the agents handling the deal on behalf of the vendor after a period of time that the lessor, in this case, the sale and leaseback, was only prepared to take a 7-year lease and that they'd been offered a better price than what we were offering. We made a decision to not pursue this investment any longer because of the fact it was a 7-year term, and it meant we didn't have a proper exit mechanism because we were putting it into a fund that had a 5-year life, and we felt if we had 2 years left on the lease that the property would be penalised because of the risk, as well as not knowing what the future would hold in 5 years' time. So that's one of the things I would suggest to you, is that stick to your investment principles, apply a lot of risk management in times like this, make sure you're getting long leases so that if there is the normalisation of rates that are going to take place eventually, and you're caught in that cycle where there will definitely be some serious adjustments, that you're able to see that period through and come on the other side. At the end of the day, it's all about income that is derived from properties and sustainable income, and that you don't get yourself into a situation where you have so much debt that the debt becomes a problem and therefore you are forced to give up the asset you're holding. Now, I want to touch on some of the myths that appear in the economic markets, and these myths keep coming up every time we have different economic cycles. One of the myths is that this time it's different, and we've heard that so often in the economic environment. I've been investing for 50 years, and every time there's been an economic cycle, I've heard the same refrain that this time it's different because the Chinese are going to have an appetite that's going to be insatiable for iron ore or resources or one thing or another. Well, it's never different. It's always a variation on a theme. The difference we're seeing at the moment is that we saw an economic cycle which was a very drastic one in 2008, which has been prolonged by the central banks. But at the end of the day, it's still got to see its way through until the system is purged of all the bad habits that took place before, people have repaired their balance sheets, and that we can move on having taken all the toxic treatment we needed to do to get rid of the bad habits that took place. I've also heard about this wall of money theory, and that's obviously very apparent at the moment, All the newspapers are saying there are all these countries around the world wanting to invest in Australia, and that is very true. Australia is a very attractive place for economic investment. But this idea that this overwhelming amount of money flushing around the world is something that you can rely on going forward in perpetuity is an anathema, it's a myth. The one thing you need to understand is that the money flows where the money believes the best opportunities are. And if those opportunities are going to change, then that money is going to change as well. So don't rely on the compression of yield based on the wall of money theory. And don't buy properties because you're a momentum player that's going to believe that yields are going to compress because of this wall of money theory. You might be horribly disappointed. There's also the other myth about the efficient market theory. I don't believe markets are efficient. And the reason why I don't believe that markets are efficient is there are so many people who invest in markets, and everybody have different objectives about how they invest. To give you some examples, there are lots of people that have a risk appetite which is different to other people. They also have objectives that are much lower in terms of the returns they want to get out of investments. And therefore, one can't say that markets are totally efficient because everybody has a different agenda of what they're trying to achieve. Let me give you some examples. We're in a very hot market at the moment, right around the world in terms of property. And let's talk more particularly about Sydney. I just saw a deal that we were looking at the other day, which was a long lease to Coles on a logistics centre in southwest Sydney. And the price we were looking at to pay, and we're fairly adept at these industrial property markets, was somewhere in the region of about 6.25%, which gave us an unleveraged IRR of about 8% over a 10-year period. We were prepared to pay about 6.25%, and this property went at 5.5%, which we thought was expensive. Now, it was expensive to us because our cost of capital is much higher than some other people. But if you were, say, a superannuation company or Challenger, which writes a lot of annuity business, and you were writing annuity businesses where you were doing annuities for 20 years at sort of 4.5%, and you could buy a property at 5.5%, and you've got this liability of the annuity, which you can match with an income stream of 5.5%. From an annuity provider, their objective is being met because their actuarial requirement is to match that liability with an asset. So therefore the market is extremely big, and things are happening in the market for different reasons. I'll give you another example. The other day I had a call from CB Richard Ellis Capital Markets, and they came to see us. And they have been appointed by some life assurance and superannuation companies from America, who are very happy to provide debt into the Australian market on longer terms than our major banks are prepared to do. They're prepared to do debt terms of 7, 10, 15 and 20 years. They're also prepared to do it without any concern about covering off the risk, the exchange risks on the Australian dollar, as they are lending around the world and getting a blended outcome from their point of view. They're also prepared to do it on a reference rate based on a swap and not entering into a swap, as they're going to do this out of their own money unlevered from America. And they're prepared to do it at competitive rates. Now, why would Americans be coming in to lend money into our debt markets? It's very simple. If you were an American company and you had set certain of these assets for a term of, say, 10 years ago, and some of these things are starting to mature, and you've now got to look for investments to match with other liabilities you have on your books, and you've got to deal in the American property markets where 10-year yields are about 2% and 30-year yields are about 2.3%, and you can come to Australia and get much better outcomes. You're probably going to do that because of the shortfall you have in trying to match these liabilities with assets. So there's just one player who's providing debt now in the markets who needs to reach for yield, as we talked about, and is prepared to do this on this basis. Another myth we're going to deal with is property only goes up in price. Well, over long periods of time, property does go up in price. There's no question about it. But it's all about timing. I'll give you some examples where people have lost a lot of money on property, not based on nominal terms, but on investment terms based on measurements over long periods of time. So if I can refresh your memories, in 1987 we had the stock market crash in America, and that was followed up with investors around the world going into the property markets. And from 87 to 89, people bet up the prices of property right across the world, and in Australia, just so I can remind you, there was a frenzy to buy properties, and we had the Japanese and various other people trying to buy into these markets, as they successfully did and lost a lot of money. Now, to give you an example, Grosvenor Place in 1989 at its apex was valued at $1.05 billion. And we then had the recession we had to have, as Paul Keating said, and by 1991 we had the most depressing property market in 100 years in Australia. Now 1991-92, it's not going to be that believable around this conference, but Grosvenor Place was valued in 1992 at 460 million. Grosvenor Place had lost something in the order of 55 to 60% of its value. And there are many examples I can give you across Australia during that period of time that the outcome was very similar. So property does go up over long periods of time. To give you an example, Grosvenor Place has only exceeded its value about 2 years ago. So from 1992 until about 2012, it took 20 years for Grosvenor Place to actually recover that nominal value. The other myth that I hear is that debt adds value. Well, I can tell you debt adds no value to anything you buy. All debt does is allow somebody to buy something which they don't have the ready money to buy and they can't afford to buy it, so they take on debt in order to buy something like a house or even a commercial property. So debt doesn't add any value. All debt does is it puts you in a position where you're owing somebody some money, and it's putting you in a riskier position. Now, if you're prepared to take that risk, as many people are prepared to take it when interest rates are very low, because the cost of debt is cheaper than the value getting out of an asset, that's fine, provided you understand the risk and provided you're compensated for taking on that debt. So it's no use taking on debt if you're not going to get some increased income out of the investment you're making, and that you can quantify that increased outcome for the risk you're taking. So be mindful that debt adds no value. All debt allows you to do is to, in some times like now where interest rates are very low, to achieve better outcomes from your investment and also buy things that you really can't afford, and provided you've got an income flow and can pay it back, that's fine. But remember that. The other thing I hear about is relative returns, and all fund managers are very boastful about the fact that they use relative returns to judge themselves as to how they're doing against the rest of the market. I personally think it's the wrong thing to do. And the reason why, I'll tell you why I think it's the wrong thing to do, is that I'm sure there are a lot of golfers around in this room today. And when you go and play golf on a weekend and you're playing with your buddies and you score a certain amount and they score a certain amount, and you come home and you say, well, you were very good against your friend because he had a 9 over and you had an 8 over, that's fine. But how do you rate yourself against the best professional golfers? That's what counts, because that's what I'm talking about, an absolute outcome. So if you want to be in the funds management business, stop using relative returns, start using absolute returns, and start being professional and being the best, because that's what you're expected to be. You're a custodian of other people's money, you're a manager, and if you think it's good enough each year to say you did better than somebody else who's also mediocre, I don't think that's the way to go. The other thing that I hear about is the myth about a lay-down misère. Now, I don't know if you all know where the word lay-down misère comes from, but misère is from a card game, and it's called 500. And it actually is where somebody has an unbeatable hand, and the hand is so unbeatable that they can put it down on the table, and every card player around the table will accept that they can't get a trick. Well, let me tell you something, there's no such a thing as a lay-down misère. And the reason why I say that to you, whenever you make an investment, there is going to be some risk. The only risk-free investment you can make is a government bond of a reliable country that's been around for a long time. And even then, you're only going to get your money back nominally, and you might lose money on the inflation side. But I want to tell you a little bit of story about me and thinking there was a lay-down misère. In 1978, I made an investment in a property in California in Beverly Hills. There might be some of you in the audience who've been to California and been to Beverly Hills, and there is a road there called Rodeo Drive, which is a famous road, particularly for high-end fashion. And that runs into a T-junction at Wilshire Boulevard, where there's the famous Wilshire Hotel. If one was looking down towards the Wilshire Hotel, on the right-hand side of the property of the Wilshire Hotel is another block of a property, which was an office block. And in 1978, I joined a syndication in America of ex-South Africans who, together with a guy called Michael Mulkin, and you'll probably remember him because he was the father of the junk bond introduction. He was one of the main directors of Drexel Burnham, and they decided to do a lease at this property for 20 years. And in those days, Drexel Burnham was one of the leading stockbrokers in America with a capital of about $2 billion. And that today would be the equivalent of about $30 billion for a stockbroker. That was a serious player. Anyway, we did this 20-year lease to them, and Michael Mulkin became the victim of racketeering in America. They wanted to make a scapegoat because of the junk bond deals that went wrong. He was fined, together with Drexel Burnham, something like $700–800 million. They had to liquidate. The Californian branch was still viable, and they came to us and they said to us, look, we're not going to be able to pay you the $10 million a year on that property. And the only way we're going to be able to satisfy you, and not totally, is give you a penalty walk away of 1 year's rent, which was $10 million, and we've got to downsize, otherwise we're going to go and solve it. So our syndication had no alternative. We had to accept that, and we were able to use the $10 million to lease up the building, but we only got to 57% because Los Angeles in those days was in a downturn where occupancies had risen dramatically in 1982, if you all remember the major recession in America. And as a result of that, we had to go into Chapter 11. Now, Chapter 11 in America is an ability to get a judgment that allows you a halfway house to try and re-establish yourself and work your way out of the conundrum you've got arising out of this debt. Anyway, we went into Chapter 11, and after several years, the bank said to us that they want us to come out of Chapter 11, and the bank bid against us, and they won the property, and we lost that property. Now, think about this. 20-year lease to Drexel Burnham, one of the best locations in Beverly Hills. It was a lay-down misère, because when I told people about this property, they said, you are so smart, how did you get into this thing? Well, here's a situation where there was a black swan event and we lost the property. So don't buy the idea that there always lay-down misères. There's always risk in whatever you do. The other thing, the myth is that there's always going to be debt available. That's another myth. The fact that you've always been able to get debt in the past and you have a great relationship with your bankers is one thing. But remember, banks are also very fickle. And you've heard the old story, they've got all their umbrellas out in the sunshine, and when it starts to rain, they pull them in. So don't think that debt's always going to be available, and the 2008 debacle was a good example that the banks were only available to the people that they thought were the most trustworthy and the ones they wanted to deal with. So don't rely on that. The other myth is you can trust governments and business. Well, don't trust any governments and business. Governments have been lying to their populations for years. Inflation, as an example, is one of the biggest lies. It's a hidden tax that governments have been enforcing on people for time immemorial. I might tell you of something recently that happened which will give you some indication of how unreliable governments are. You might have followed the fact that the Swiss government had pegged the Swiss franc to the euro. But when everybody was changing their euros into Swiss franc, it became untenable for the Swiss economy that the government had to keep printing Swiss francs in order to support the euro. There were many hedge funds across the world who played this game, that they were able to profit out of the fact that the Swiss franc was pegged to the euro. And overnight, about 2 months ago, the Swiss central bank withdrew the peg, the Swiss floated up, and millions and millions of dollars were lost around the world, and some of those hedge funds went insolvent overnight. So don't trust governments and business, even though they tell you that they're on the path to doing things and won't change that path. They're very expedient and they will do what is necessary in order to survive. A lot of people also believe that they don't need to worry about the future because the future in many ways is set in stone and that things can't change. Well, I would recommend to you that you all read 2 books. One's called Fooled by Randomness and the other one's called The Black Swan. They're both written by the same author, and I suggest you get these books because they really will tell you something about how difficult it is to predict the future, because there's always something out there that you don't know about, and the fact that you don't know about it doesn't mean it's not there. The reason why I titled the one book called The Black Swan is that 200 years ago in Europe, nobody believed there was a black swan in the world. And the fact they'd never seen one, they never believed it existed. Until Australia was founded and the black swan was found in Perth. So the fact that you don't know about something doesn't mean it doesn't exist. And therefore, you need to be very conscious when it comes to risk management that things can happen to you even though you don't believe they exist. Now, I've touched on the myths. I now want to talk to you about what I believe are the principles for building good businesses. I was one of the founders of Charter Hall, and we started about 23 years ago. And we started in the midst of a property depression, which I talked about earlier, in 1991. And there was very little happening in the Australian markets. We started with 4 people. And we did whatever we could in order to keep the business afloat. And today we're a company with 400 people. Now, I don't want to labour how smart we were because we had a lot of luck along the way. And we never dreamt that we'd be able to build a building from scratch, a business from scratch to get to these sort of levels. But along the journey we took, one of the important things I think that we learned was that you need to have very strict principles about what you want to do in business. And those principles need to be based on great veracity, trust, and building confidence with the people that you do business with, for a number of reasons. People like to do business with people they trust, and even if you make mistakes and they know that you've made those mistakes without the intention of any malice or trying to profit egregiously out of them, they'll go along with you because everybody in business knows that everybody makes mistakes. The other thing about building good businesses is really to employ the best people and do the best thing you can in terms of the exemplar you want to be in the businesses you run. As I said to you earlier, it is no use trying to build a business where you want to be able to do things on a relative basis to what everybody else is doing. Because if you're going to be mediocre like everybody else, you're never going to be building really good businesses. You've got to do the best. The other thing that I suggest to all of you in this room is that knowledge is power. And unless you put in an enormous amount of effort of building up knowledge, as well as broadening your experience in whatever business you want to be in, so that when you do make presentations and meet people, that they have the confidence to know that you're a smart guy. The other thing is, it's not good enough to just dwell on micro issues, and micro meaning that you only know about Australia and are Australia-centric. I do believe that you shouldn't go into businesses outside of Australia unless you have very good partnerships, or unless you've surveyed and looked at those overseas markets for long periods of time. But the one thing I do believe is you need to have a macro understanding of what's happening in the world as far as economics and other things are concerned. And the other thing I suggest to you is as well, that if you do build up a good business, always be very caring and very concerned and very, very people-focused, that you connect with your people. Because at the end of the day, in a service business, without the right people, we really don't have a business at all. So let me wish you all a wonderful conference. I'm sorry I can't be with you. I am hoping that after you've watched this video, that we'll be able to connect a telephone into your conference room where I'll be able to take some questions and perhaps give you some good answers as well. To Paul and all the people who've gone to the trouble of arranging this seminar, I'm sure it's going to be a great success. Thank you for the invitation. I'm really sorry I haven't been able to be with you, but if you want to invite me one day in the future, I'll be delighted to come and talk to you again. Thank you.